Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. And let me tell you, our next deep dive is going to be a wild ride through the deep blue sea of offshore drilling. Get ready because we are about to unpack Valaris Ltd's latest annual report. And let's just say, it is packed with more drama than a CEO's vacation photo album. If you love getting these kinds of insights, make sure you are subscribed and check out our Discord community linked in the description below. Let's get started. Alright, so Valaris Ltd, they're a big player in the offshore contract drilling scene. Think massive rigs out in the ocean, drilling for oil and gas. They've got a huge fleet, some of the best deep water rigs, and a leading collection of premium jackup rigs. As of February 2026, Valaris owned 46 rigs. That is a serious number, including 13 drillships and 31 jackup rigs, plus a half stake in a joint venture called Arrow that owns 9 more. Their customers are the big oil and gas companies, the big government-owned ones, and also smaller independent operators. They operate all over the world, from the Gulf of America to South America, Europe, the Middle East, Africa and Asia Pacific. They make their money by drilling on a day rate contract. Basically, they provide the rig and the crew, and they get paid a daily fee. Their customers handle the actual well construction and the risk if the well is a dry hole. Now, here's a plot twist for you. Valaris is in the middle of a big deal. A merger with Accession Ltd. They signed an agreement back in February 26 where Accession will buy all of Valaris's common shares in exchange for Accession shares. The plan is for Valaris shareholders to end up owning about 47% of the combined company. This is by way of a court-approved scheme of arrangement, which sounds super official. This merger is a huge deal, and it is still waiting for a bunch of approvals, like shareholder votes and regulatory okays. If it doesn't go through, Valaris might have to pay Accession a hefty fee, around $173 million, and all the effort spent on this deal could be for nothing, potentially hurting their stock price. The offshore drilling business is like a roller coaster. Its ups and downs mainly depend on how much oil and gas the world needs and how much customers decide to spend on finding it. When oil prices are low, companies tend to spend less on drilling. But the report suggests that over the next few years, the oil market might get tighter. Big offshore projects, especially in deep water, are seen as offering great potential and being more cost effective. So even with some price uncertainty now, more offshore projects are expected to get the go-ahead. It is a tough business, and to stay competitive, companies need the right kind of rigs ready for the job. Rig attrition, meaning older rigs being retired, has actually helped shrink the global fleet, which can be a good thing for demand. Let's talk about their toys, their drilling rigs. As of February 2026, Valaris had 46 rigs in total. They break them down into floaters, which are drill ships and semi-submersibles, and jackups. They also have their share in Arrow. The report lists out all their rigs, giving you details like the rig name type, when it was delivered, its capabilities like water depth, and where it is. For example, they have drill ships like Valaris DS4, delivered in 2010, capable of drilling in 12,000 feet of water and 40,000 feet deep, currently working in Brazil. They also have jackups like Valaris 72, delivered way back in 1981. Working in the United Kingdom, some of these rigs are under contract, some are preparing for future contracts, and some are being preservation stacked, which basically means they are parked but kept in good condition to be ready to work again. Now for the juicy financial bits, let's peek at the numbers. This table here shows how busy their rigs were. For the total fleet, floaters, which are their big drill ships and semis, had a utilization rate of 54% in 2025. That means over half of their floating rigs were not actively drilling. For jackups, it was a bit better at 61% utilization. The other category, which includes rigs leased to Arrow, was almost fully utilized at 97%. For Valaris as a whole, their total fleet utilization was 65% in 2025, down slightly from 67% in 2024. Now, 65% utilization might sound okay, but when you consider that a rig earning 0 day rate while stacked is still costing money to maintain, it means a good chunk of their fleet wasn't making money. Their joint venture, Arkansas, is doing much better, with 86% utilization in 2025. But utilization is only half the story. How much are they actually earning per Dalton Y? For floaters, the average daily revenue in 2025 was $386,000. That is up from $345,000 in 2024, which is a good sign. For jackups, it was $138,000 a day, also up from $121,000. The other category, those leased rigs, is much lower at $51,000 a day. Overall, Valaris' average daily revenue across all their rigs was $179,000 in 2025, up from $165,000 in 2024. This shows they are getting better rates for the rigs that are actually working, which is crucial for profitability. Let's look at the overall income. Total operating revenues for Valaris remain pretty steady in 2025, coming in at about $2.37 billion, almost the same as 2024. But digging deeper, the core revenues, the money earned from actual drilling, not including reimbursements, actually dropped slightly by $4 million. This small drop is despite them getting higher daily rates. Why? Because they had fewer operating days. Some of their big floater rigs finished their contracts and are either stacked or retired. This is a classic industry problem. You can get good rates for your active rigs, but if too many are sitting idle, the overall picture can be mixed. On the cost side, contract drilling expenses, not counting depreciation, dropped by a significant $141 million in 2025 compared to 2024. That is a 9% decrease. This is mainly because those idle or retired floater rigs are costing less to maintain. The report also mentions a reversal gain related to a patent lawsuit which helped reduce expenses further. However, personnel costs did go up a bit, mainly because their jackup rigs had more operating days. Here is a tough number, a $27.3 million loss on impairment in 2025. This means they had to write down the value of some of their assets because they are no longer considered recoverable. The report states this is related to retiring 3 semi-submersible rigs and 2 jackup rigs, and classifying another semi-submersible as held for sale. Essentially, these rigs are worth much less than what the company had on its books. This is a clear sign of the industry's ongoing challenges and the need to streamline the fleet. The good news is that despite the impairment losses and a slight dip in core revenues, Valaris' net income attributable to them more than doubled in 2025, jumping to $982.8 million from $373.4 million in 2024. That is a massive 163% increase. This huge jump is largely thanks to over $100 million in gains from selling off assets and a significant tax benefit. This really highlights how selling off older or underperforming assets and getting major tax breaks can dramatically change the bottom line, even if the core business isn't growing substantially. Let's touch on their joint venture, Arkansas O. In 2025, Valaris reported an equity earning of $8.4 million from ARO, a big improvement from a loss of $11 million in 2024. This joint venture seems to be turning around, which is good news. Looking at other income, it surged from $17.9 million in 2024 to $75.3 million in 2025. A big reason for this jump is the money they made from selling off assets like rigs and their Angola office, totaling over $115 million in pre-tax gains. Now for the tax story in 2025, Valaris got a huge tax benefit of $426.8 million. This is largely because they were able to reduce a valuation allowance by over $523 million. A valuation allowance is basically a buffer for potential future tax losses. When you can prove you are likely to make profits, you can reduce this allowance, which shows up as a tax benefit. They also had some specific tax expenses, adding up to a net benefit. Their effective tax rate for 2025 was a negative 77.3%, which is unusual but tied to these tax adjustments. When we look at cash flow from operations in 2025, Valaris generated $546.2 million, which is up from $355.4 million in 2024. This is a healthy increase, partly due to their operating income and tax refunds they received. They also made over $137 million from selling assets. They're spending on capital expenditures, which is money spent on maintaining and improving their rigs and facilities, was $343.5 million in 2025. This is down from $455.1 million in 2024. It seems they spent less on big upgrade projects in 2025. They expect to spend between $425 and $475 million on capital expenditures in 2026. Mostly for maintenance and upgrades. Valaris also disclosed their share repurchase program. They were authorized to buy back up to $600 million of their shares. In the last quarter of 2025 alone, they bought back about 500,000 shares for an average price of around $52 per share. This strategy can boost shareholder value by reducing the number of outstanding shares. Valaris is heavily international. In 2025, a massive 86% of their revenue came from outside the US. They operate in many countries, which comes with its own set of risks. Political instability, different laws, currency fluctuations, and even things like piracy can affect their business. They have insurance, but it might not cover everything. And customer indemnities are crucial for handling potential losses. Let's talk about the risks. The merger with Transocean is a big one. As the report states, our pending business combination may be delayed or not occur at all for a variety of reasons. If it falls through, Valaris could owe Transocean a lot of money, and it could really hurt their reputation and ongoing business. Plus, While this deal is pending, Valaris has to keep running its business as usual, but with restrictions on what they can do, like selling assets or taking on new debt. It is a delicate balancing act. The biggest risk for Valaris and really the whole industry is oil and gas prices. When prices are low, oil companies cut back on spending, and that means less work for drilling companies. The report spells this out clearly. High oil prices don't always mean more drilling either, because companies might be cautious about future price drops or might shift their focus to other energy sources. The industry is also highly competitive and cyclical, meaning periods of boom are often followed by busts. Speaking of contracts, Valaris has a pretty solid backlog of work, about $4.7 billion as of early 2026, but this backlog isn't guaranteed. Contracts can be cancelled or renegotiated, rigs can break down and face other delays. The report warns that even if they have a backlog, the actual revenue earned could be less than expected. They also highlight that customers might not be able to pay or could demand lower rates, which is a serious concern in this cyclical industry. Cybersecurity is a big one too. Their operations rely heavily on technology, both on the rigs and in their offices. A cyber attack could disrupt operations, lead to data theft, and cause significant financial and reputational damage. The report admits that while they have a cybersecurity program, there is no guarantee it will prevent every threat. The Arrow joint venture, while improving, still carries risks. Valaris could face issues if their partner, Saudi Aramco or Arrow itself, faces financial difficulties. They also have a big loan to Arrow that might need to be extended, and Arrow has plans to buy more new build jackup rigs, which could require Valaris to chip in more cash. Looking at the financial statements, Valaris' net income for 2025 was almost $1 billion, a huge jump from $373 million in 2024. This was significantly boosted by selling off assets and a large tax benefit. Their total operating revenues were pretty flat, around $2.37 billion in 2025 and 2024. But expenses decreased quite a bit, mainly because fewer rigs were active and they had lower maintenance costs. They also took a $27 million impairment charge, showing they had to write down the value of some rigs that are being retired. The company's market value for their common shares was about $2.5 billion as of the 30th of June 2025. They also had about 69 million shares outstanding. The pending merger with Transocean is a major event that will reshape the company. Now let's look at the big picture here for Valaris. On one hand, they've managed to improve profitability significantly in 2025, largely through asset sales and impressive tax benefits. Their core revenue held steady, and they are getting better daily rates for their active rigs, which is positive. The Arrow joint venture is also showing signs of improvement. However, the substantial impairment charges are a stark reminder of the challenges in the offshore drilling market where older or less competitive assets can become a liability. The pending merger with Transocean is a massive strategic move that could create a much larger, potentially stronger player in the industry, but it also carries significant execution risk. The reliance on volatile oil prices, intense competition, and the ongoing need to manage their fleet effectively remain key concerns. The company is clearly trying to stay lean and focused on higher quality assets as seen by the sale of older rigs. So, what is the verdict? Valaris is navigating a tough but potentially recovering market. The merger is the dominant story right now, a high-stakes gamble that could pay off big if successful, or lead to significant headwinds if not. Their diversified operations and focus on premium assets are strengths. But the cyclical nature of the industry and the inherent risks of offshore operations mean they will always be managing a delicate balance. That is our deep dive into Valaris' 2025 annual report. What do you think about their financial performance and the upcoming merger with Transocean? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button. It really helps the channel, and subscribe for more corporate dissections. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching. See you next time.